On Wednesday, January 15th, we saw the latest reading of US CPI, which came in as expected at 2.9% on the headline year over year, but was slightly lower than expected on the ex-food and energy component, both month over month and year over year. Now, the CPI, coupled with the PPI from the day before that also came in lower than expected, helped push the US dollar down by almost 1.5% against an average of developed world currencies. Now, since late September, the US dollar's been surging, rising over 10%, putting in a high on January 13th. The domestic narrative was a potential resurgence of inflation, which could force the Fed to hold off on further easing, and the potential for increased global investment if there was a sense that the US was on the cusp of a more business-friendly, tax-friendly, and regulatory-friendly environment. Now, one of the currencies that suffered the most against the US dollar was the Australian dollar, which had fallen over 11.5% at its lowest point. The disproportionate loss was attributed to the market's view that Australia was caught in the middle of a potential trade conflict between the US and China, its most important trade partner. What's interesting about the recent price move is that the Australian dollar bounced back significantly following the good domestic inflation news, even though the China story persists. Now, many traders believe that the bounce was tied to heavy short positions in the currency, which could exacerbate the upward movement. Now, the CME Group offers 3 different sized currency contracts, the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We're going to be using the micros in these examples. If a trader believes the Australian dollar could bounce from here, they could express that by buying the March micro Australian dollar futures contract at 0.6226 and target a move to the late November highs of 0.6550. Now, a stop for this trade can be placed below at 0.6040. This trade can make $324 if the target is reached and risks $186 if you're stopped out of your level. Now, if a trader believes the Australian dollar could continue its longer-term path lower, they could sell the March micro Australian dollar futures contract at 0.6226 and target a move to the January lows of 0.6135. Now, a stop for this trade can be placed above at 0.6305. This trade can make $91 per one lot if the target is reached and risks $79 if you're stopped out of your level.